Fixed Income Market Outlook May 2023. Inflation softens, commodities and INR stable. Inflation trajectory in India has seen a gradual fall aided by softer commodity prices and monetary policy. March WPI inflation moderated sharply to 1.3%, February 3.9%. Improvements in the external sector have also meant the INR has remained stable over the last 3 months. The INR stood firm at 81.78 USD. The three in unison provide much needed comfort for policy makers given the strong domestic macro environment. Bond yields cool, benchmark 10-year G-Sec drops to 7.11%, cooling inflation. RBI pausing rate hikes and a stable macroeconomic environment cooled bond yields across the curve. Money market rates saw yields drop by 11 bps while 3-year AA corporate bonds saw yields soften till 20 bps. Long tenor SDLs and G-Secs also saw yields soften 15-20 bps. GST collections at new life high, economic activity buoyant. GST collection for April, reflecting activity in March, came in at an all-time high of 1.87 lakh rupees crores. PMI manufacturing rose to a 4-month high of 57.2 in April. On the consumption side, services PMI accelerated to 62 in April, the highest since June 10, with the upturn driven by a pickup in new business growth and favorable market conditions. Air passenger traffic gained pace in sequential terms and remained steady in YoY terms. Strength from all quarters of the economy indicate a high degree of positivity in the economy. IMD forecasts a normal monsoon according to the preliminary forecast for the 2023 monsoon season, June to September. IMD anticipates the southwest monsoon rainfall for the country as a whole is likely to be 96% of the long period average, LPA. Markets were factoring concerns of an impending El Niño event that causes drier conditions and lower rainfall in India. Agriculture and allied activities constitute till 18.2% of GDP. The growth in the sector is influenced by the monsoon as 51% of the cropped area is monsoon dependent. US Fed commentary, hint of pessimism, incremental action will be data dependent. The US Fed raised rates yet again, 500 bps rate hike since March 2022 to its highest level since 2007, even as the regional banking crisis claimed another banking victim, First Republic Bank. Despite the fear of a near-term recession, the US Fed believes the economy and the banking sector are stable. We believe rates across the world are likely at peaks and the world economy might encounter a period of extended rate pauses till policy makers confirm an inflation cool-off. Market view. Markets have seen an expected fall in rates, as is the seasonal nature of bonds during the FY closing. The large inflow into mutual fund schemes in the last days of FY23 and the subsequent bond buying in April has also been a trigger for yields across asset types to cool. Our call to add duration in Q4 FY 2023 achieved twin objectives of locking in elevated rates for target maturity fund investors and capitalizing gains on the duration play in actively managed portfolios. Growth has returned to its central place in RBI's framework. With inflation projected to fall below 6% and no mention of the 4% official target of inflation, it appears that RBI is comfortable with its projection of inflation in the coming year. Average inflation is projected at 5.2%. GDP growth was marginally marked up to 6.5% for FY24. The impact of the 290 bps of tightening over the last year is now expected to affect the real economy. The clear emphasis seems to be support for growth unless inflation again surprises above 6% consistently. Lastly, the RBI is mindful of the large government borrowing programme this year. With this in mind, the RBI also indicated that it would be agile in liquidity management. We are now close to a neutral liquidity position, And at the current pace of outflows, currency and reserve demand, the liquidity demand from the RBI is likely to be close to 4 lakh rupees crores. A part of this can be filled by forex flows if the currency is stable and financial conditions globally are easy. However, it is likely that the RBI will need to respond to liquidity needs through open market operations later this year. The current curve continues to remain flat with everything in corporate bonds beyond 1 year up to 15 years is available at 7.0 to 7.25% range. Falling CPI, weaker growth and strong investor demand would keep yields under check despite high G6 supply next year. We retain our stance of adding duration to portfolios in a staggered manner given that a large uncertainty driving rates and duration calls in now out of the way. Actively managed portfolios with mid-moderate duration mandates offer compelling investment solutions as compared to traditional savings instruments given that both assets have parity in tax treatment. Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.